All right, let's talk managerial and cost accounting. We're going to break down some of the absolute must-know concepts you're going to face on the BAR exam. But look, this isn't just about memorizing formulas to pass a test. This is about learning the language that drives actual business decisions. So let's get into it.
Think of this session like we're building a manager's toolkit, piece by piece. First, we're going to start with the fundamentals, what I like to call the DNA of costs. Then we'll figure out how to properly assign those costs to our products. After that, we can use all that great info to plan for profit and, of course, analyze how we actually did. And to wrap it all up, I'm going to give you a super useful framework to help you crush any question that comes your way.
Okay, let's dive right into the heart of it. Part 1 is all about understanding the DNA of costs. You see, before you can manage, control, or plan anything in a business, you have to understand how costs behave. How do they react when things get busy or when they slow down? Seriously, get this part down and everything else we talk about today will just click into place.
So let me start with a really fundamental question. Is every single dollar of cost created equal? The answer? Absolutely not. Not even close. Some costs are going to move right along with you, while others are just going to stay put. And understanding that difference, that is the absolute key to unlocking all of managerial accounting. It's a concept the exam loves to test over and over again.
So costs really fall into 3 main buckets. First up, you've got your variable costs. These change in total in direct proportion to your level of activity. Think more production, more cost. Then you have fixed costs. These guys stay constant in total, no matter how much you're making. And finally, you've got mixed costs, which, you guessed it, are just a hybrid. They have a little bit of a fixed component and a little bit of a variable component.
Okay, now here's where we need to be really careful. We're looking at this through one lens first, total cost. This is the big picture view. As you produce more and more units, your total variable costs, like the raw materials for each product, they're going to go up in a nice straight line. But your total fixed costs, like the monthly rent for your factory, are going to stay flat, at least within a certain capacity, which we call the relevant range.
But now, watch what happens when we flip the script and look at the cost per unit. The logic completely reverses, and trust me, this is a classic exam trap. That variable cost for each individual item, say $5 of steel for one widget, that stays constant. It's always $5. But the fixed cost per unit, that factory rent gets spread out over more and more units as you produce more. So the per unit fixed cost actually goes down. Grasping this inverse relationship is non-negotiable. So the big takeaway here is this. Cost behavior is not a single idea. You have to be able to analyze costs on both a total and a per unit basis to really understand the full story.
So now that we've decoded the DNA of our costs, what do we actually do with that knowledge? Well, we need a system, a way to accurately attach these costs to the things we're making. And this isn't just some boring accounting exercise. The costing system you pick can have a massive impact on your company's reported profit.
The big showdown you are guaranteed to see on the exam is absorption versus variable costing. And you know what? It all boils down to one critical difference: how we handle fixed manufacturing overhead. Under absorption costing, fixed overhead is treated as a product cost. It gets attached to the inventory. But under variable costing, it's treated as a period cost. It gets expensed right away in the period it happens. This one little difference changes everything.
Let's make this real with an example. Check this out. We made 1,000 units, but we only sold 800, so we have 200 units left in inventory. Under absorption costing, the fixed overhead tied to those 200 unsold units, that $2,000, it gets trapped in inventory on the balance sheet. It's not an expense yet. But with variable costing, the entire $10,000 of fixed overhead hits the income statement right now. And the result? Anytime production is greater than sales, absorption costing is going to report a higher net income. Period.
Now, beyond that main comparison, you'll see a couple other systems. Job order costing is what you use for unique, one-of-a-kind things. Think building a custom house or a super yacht. We traced every cost to that specific job. On the flip side, you've got process costing. This is for mass production of identical items, like cans of soda, where we just average the costs over thousands and thousands of units.
But what if we want to get, well, way more accurate? That's where activity-based costing, or ABC, comes in. You see, traditional methods often use a single broad overhead rate, like direct labor hours, to spread costs around. The problem is, that can really distort how much a product truly costs to make. ABC gives us a much sharper picture.
So how does ABC work? It's actually pretty intuitive. Instead of one big bucket of overhead, we create smaller cost pools for major activities, like setting up machines or performing quality checks. Then, for each pool, we identify a cost driver, the thing that actually causes that cost to happen, like the number of setups or the number of inspections. By linking costs to the activities that actually drive them, we get a way more accurate product cost, and that's vital for making smart decisions about pricing. The takeaway is this: your costing system isn't just an accounting choice, it's the lens that shapes how a company views its own success.
All right, so our costs are properly assigned. We've got our second tool. Now we can grab the third tool from our toolkit, planning for profit. This is where we use something called cost volume profit analysis, or CVP, to really understand the dynamic relationship between our sales, our costs, and our profits.
The absolute core, the beating heart of CVP, is the contribution margin. The formula is as simple as it gets: sales minus all your variable costs. I want you to think of this as the engine of profitability. It's the total cash generated by your sales that's available to do two things. First, cover all your fixed costs, and then whatever's left over, that's pure profit.
And of course, we can zoom in and look at this on a per-unit basis. The contribution margin per unit is just the selling price for one item minus the variable cost for that same item. It tells you exactly how much firepower each individual sale brings to the table.
And this leads us directly to probably the most famous formula in managerial accounting, and one you're guaranteed to see: the break-even formula. To find your break-even point in units, you just take your total fixed costs and divide by that contribution margin per unit we just calculated. This gives you the magic number, the exact number of units you have to sell to cover every last penny of your costs.
Let's run a super quick example. Let's say we sell a product for $100. All the variable costs to make and sell it are $60. You do the math. 100 minus 60 gives us a contribution margin per unit of $40. Every single time we make a sale, $40 gets added to the pot to help cover our fixed costs. Now let's say our total fixed costs for the month, our rent, our salaries, all that stuff, come out to $20,000. We take that $20,000, we divide it by our $40 contribution margin per unit, and we get 500 units. That's it. That's our break-even point. We have to sell exactly 500 units to make zero profit and zero loss.
And here's the beautiful part. At 500 units, we're safe. We've paid all our bills. But that very next unit, number 501, its entire $40 contribution margin goes straight to the bottom line as pure profit. And so does unit 502 and 503, and so on. The takeaway is that CVP analysis isn't just about looking backward. It turns our cost data into a forward-looking roadmap for hitting our profit targets.
Okay, planning is awesome, but we all know that plans don't always survive contact with reality, right? We need a way to look back and see how we actually did compared to that plan. And that's where our next tool, variance analysis, comes in. It helps us answer the why behind our results. Most cost variances boil down to a really simple but powerful logic: price versus quantity. For any of our inputs, like materials or labor, we're basically playing detective and asking two questions. First, the price variance: did we pay more or less for each pound of material or each hour of labor than we planned to? And second, the quantity variance: were we efficient? Did we use more or less material or labor than we should have for what we produced? This split is great because it helps us pinpoint responsibility. Purchasing owns the price, and production owns the quantity.
But wait, performance isn't all about keeping costs in line. You have to watch the sales side too. And this is a really subtle but critical concept. Take a look here. We might hit our total sales goal in terms of the number of units sold, but if the mix of what we sell shifts, our profit can get crushed. In this example, we plan to sell a lot of our high-margin premium product. Instead, customers bought more of the low-margin standard one. So even if the total number of units sold was exactly what we budgeted, our overall profit would be way lower than planned because of that unfavorable sales mix. So the takeaway is this: high-level numbers can hide the real story. Variance analysis gives you the details you need to take real control.
Okay, we have covered a ton of ground. Cost behavior, costing systems, CVP, variance analysis, it's a lot. So now let's bring it all home. Let's consolidate everything into a powerful thinking framework that you can use as your game plan to attack any question the bar exam throws at you. When you see one of those big, complex scenario questions, don't panic. Just walk through these 5 steps. First, you're going to identify the core issue. Are they testing cost behavior, absorption costing, performance? Second, figure out the goal. Are they asking you to assign a cost, analyze a profit, or evaluate a variance? Third, reach into your toolkit and select the right formula or framework. Fourth, plug in the numbers and evaluate the financial impact. And finally, and this is the part that separates good answers from great ones, interpret what that number actually means for management.
Don't just calculate. Explain the so what.
So let's leave you with this final thought to tie it all together. Mastering these tools, from understanding cost behavior to analyzing variances, it isn't just about passing an exam, it's about understanding the engine of a business. These are the very tools that allow a manager to take a plan on a piece of paper and turn it into real, measurable, and hopefully profitable performance.